Welcome everyone to keynote number 11 and the last keynote of AO Ventures before we have demo day. More details on that coming in soon. I'm here with Will, whom is a partner at Faction VC, and he's here to talk to us about raising from an investor's perspective. So I think Will is actually the first investor that we've had on our keynotes. So if you have any questions, as always, please feel free to ask them in the Q&A section, and we will stay on after the presentation to answer them live. With that being said, I'm excited to pass the mic to Will and we can get started.
Awesome. Thanks, Jesse. I guess quick intro of myself. My name's Will. I'm a partner here at Faction. The easiest way to think about Faction is we're an early stage crypto fund focused primarily at the seed and Series A stages. We invest across the stack, layer ones, all the way up to the application layer. Faction has been a longtime supporter of the Arweave ecosystem, and we're super excited to get involved with AO and help grow the ecosystem as well. Very excited to be speaking today. Jesse just told me this is the last keynote of the program. I would like to think you guys saved the best for last, but that's definitely not the case. But anyways, excited to be covering fundraising as many of you are entering demo day and will be pitching to VCs probably for your first time. So yeah, in the next, I guess, 30 or so minutes, going to cover fundraising and sharing advice from a VC's perspective. So to kind of kick things off, to understand fundraising, you need to understand what venture capital even is. A VC and the VC business model is fairly simple. VCs knock on the door of investors, who are known as LPs or limited partners, to raise a fund. Those LPs back venture capitalists based on their backgrounds, their investment strategy, their expertise, their past performance, among a handful of other attributes. That fund then will go out and invest into startups, with the goal being to deliver value to their entrepreneurs and their fund investors. Over the course of a VC fund's life, a fund will typically invest anywhere from 10 to 50 companies, depending on the strategy. And we'll get into what a fund life means shortly. But an important point, VCs do have investors. Why is this important? It's always important to understand where the money is coming from. Limited partners and investors in venture capital funds are groups like endowments, foundations, pension funds, fund of funds, individuals, and family offices. Limited partners are passive investors in venture capital funds. They do not have a decision in what companies the fund is investing in. I guess why is this important? Why do we want to understand venture capital? With crypto cycles can come euphoria, can come delusional expectations and irrational behavior. One of the most important points I want to impart on all of you is, as a founder, when you're looking to raise venture capital, it's important to understand you are a steward of capital. Raising shouldn't be construed as, oh, I'm going to go out and raise and now I'm playing with other people's money. As a founder, you want to be a good steward of capital. You should recognize you're being entrusted with capital, not given it. So what is a venture fund and how are they structured? This is super important, especially within the crypto space, to kind of understand these dynamics. The typical VC fund structure is a closed-end vehicle. What that means is the fund continues to invest for a fixed period of time. A fund's term is anywhere from 7 to 12 years, the most common being a 10-year fund life. An open-end fund is a variation, and we commonly see this in the crypto venture space. The important call out is open-ended funds have no terminal date, and they can accept investor contributions on a periodic basis, and investors can redeem during specific intervals. We are going to get into why it's important to understand these structures and what it means for you as a founder in a little bit. But yeah, I think that's probably the good primer on fund structures as a whole. And then as it comes to fund strategies, there are generalist VCs who invest across categories, sectors, geos, and then there are specialists. Specialists might have a specific stage focus. They might be pre-seed or seed investors. They may focus on a specific geo. Maybe they only invest in European companies. And you also see, obviously, the specialist firms faction, where a specialist, we only invest in crypto projects. It's important to understand these delineations, especially when you're going out and speaking to investors, as it will it'll help you tailor your pitch, tailor your conversations, and ultimately just understand like who you're talking to and what they can do, who their portfolio companies are. So crypto fund structures, this is kind of like a variation from the open end, closed end. This is super important to understand. There are crypto hedge funds and there are crypto venture funds. There is a lot of misconceptions and FUD that gets thrown out about capital partners and their role in the ecosystem as a whole. And I think it's really boils down to these two structures. Crypto hedge funds take a short-term horizon. They have a trading mentality. They're not as easily aligned with founders, and they obviously have a more liquid bias. Crypto venture funds have a long-term horizon. As we kind of mentioned with the closed-end structure, they're investing over a 10-year period. They are patient capital. They will support you over the long term, and typically their platforms have deep value add and business building capabilities you don't see with the hedge fund style model. Not all VCs are created equal. I think this is the one thing I want to underscore when you're going out and speaking to folks. It's important to understand their fund structure, their specialties, and ultimately how that affects you and the ramifications of raising venture capital money as a whole. So now we have the basics of venture. Let's get into fundraising 101. Some advice from a VC, pre-pitch, pitch, and post-pitch. To kick things off, are you ready to raise? This is a big question. Raising venture capital, raising money for your startup, it's a full-time job. Especially at the early stages, it is a full-time job. Be prepared. It's not a side hustle. Plan to devote the majority of your day-to-day fundraising. You're not going to be heads down building product. That's just sadly the truth to it. You want to sit down and organize. You need to plan ahead. Build a list of investors you want to chat with. There are a lot of great crypto VC databases out there. Look for funds that have invested in similar projects, have a thesis in the specific vertical you're building in the category you're building in. Stack rank those investors you want to reach out to and go after the bottom of your list first. Pitching takes time. It takes time to get dialed in. Practice. It's the most important thing. Naturally, as you have conversations, you're only going to get better and better. And you want to make sure the highest, priority conversations you're going to have are when you're dialed in and you have practice and things are smooth. After you pitch, your first 5-10 VCs, you'll start to anticipate the questions they're going to ask, and you'll just see the conversations flow much more organically. And I think it's super important to just double click here a second. Use your network for warm introductions. Cold intros work, but they're tough. You want other builders in the space, other folks maybe in your network, past employers, et cetera, to be connecting you. It's a signal, and VCs don't take that lightly. They look for signal, and if you can get intro to someone they respect, your conversation is going to move much faster, and you'll just find the process easier as a whole. I think once again, it's important to speak to your colleagues, speak to fellow builders, speak to people who have raised money, and they'll point you in directions you probably wouldn't have thought of and introduce you to folks maybe you didn't have on your list. And lastly, pitching, sure, you should have a pitch deck ready to go, but I also think it's important to get your ducks in order, have your supplemental materials ready. Most investors are going to ask for financials or technical architecture diagrams, a white paper. How are you thinking about the competitive landscape? What is your go-to-market strategy? You should have all that prepared ahead of going out to fundraise. It'll make your life easier and save you reps down the line. So getting into the pitch, I'm not going to give you advice on how to create a pitch deck, what to do during the pitch. I think there are a ton of great resources out there on the internet, whether it be Y Combinator or just other programs in general. The most important piece of advice I can give you as a VC is set yourself up for success. This might sound like common sense, but it's not. Be on time. Be in a quiet space with good Wi-Fi. Be on video. I've seen so many pitches where a founder is on the go in a cab, going to the airport, walking around outside. Their video is bouncing around. It's shaky. There are loud noises in the background. Doing that, you're just starting from behind, candidly. You want to set yourself up for success. One important thing to note about pitching is make it a dialogue. It shouldn't be a monologue. Don't memorize your pitch. Don't use your deck as a crutch. Be comfortable flipping through your deck and starting at random points in kind of your pitch as a whole. If an investor is super familiar with kind of the category or market you're going after, don't mansplain the market to them. It's a turnoff, and I think dialogue, not monologue, should be the name of the game. When you're building your deck and when you're pitching investors as a whole, it's important to remember one of the names of the game is building momentum. You want to create FOMO and excitement. Investors will naturally follow FOMO and excitement, and it will lead to a smoother, faster process if you can successfully do that while not being transparent with that FOMO and excitement, not spinning a false narrative. I think one other point to mention on just pitching is make sure you're prioritizing conversations with lead investors first. As an early stage company, it's easy to get caught up in numbers, speaking to smaller funds, having conversations, seeming like things are going the right direction. But really, the name of the game is a lead investor is the cornerstone of your round. Once you secure a lead, the dominoes will fall. You will be able to raise once you have a lead investor. So focus on a lead. Everything else will come quickly and smoothly thereafter. And to touch on some common questions investors will ask, you should be prepared to answer all of these. These are going to be asked, and you should have answers specifically to all of these questions. Why are your backgrounds uniquely suited for what you're building? Can you explain, the market size here? What is the TAM you're going after? What's your go-to-market strategy? Why you? Why are you going to win? What is your moat and defensibility? I think that's arguably one of the more important questions to have an answer to is how is this defensible over time? And lastly, just business model and value accrual. Investors are going to ask how you envision the company or protocol or project you're building capturing value. Is it on the equity side? Is it on the token side? If it's on the token side, how does that token specifically capture value? Is it through governance? Is there a fee share mechanism, et cetera, et cetera? These are all questions you should have the answers to. So post-pitch, some best practices. Once again, a lot of this is common sense, but send default note. If an investor asked, for those supplemental materials on a call, send them right after the call. Be top of mind. Make a VC's job easy. That's the name of the game. Obviously a biased take, but the easier you can make a VC's job, the smoother the process will be. Be patient but persistent. I think that's a very important delineation. Have a lot of irons in the fire. Expect to get more no's than yeses. It's obviously, easy advice from a VC's perspective to say, but it's sadly the truth, right? We see a lot of companies and we can only invest in a handful of them. So you need to make sure you're speaking to a lot of funds, not just one or two or three. You need to have irons in the fire, and you can't take things personally if a VC passes. It's important to build relationships over the long term. Just because they might pass on your initial round of financing doesn't mean they're not in a position to step up down the line, follow on, do a subsequent round. You want to maintain those relationships. Don't take things personally. Don't get pissed off when a VC passes. Thank them for their time. They're obviously, spending their day with you, learning about what you're building. It's important. Just don't be an asshole. It's common sense, but relationships are built over the long term. Venture is a long-term game. Don't be short-term oriented. And the biggest piece of advice a lot of first-time founders and early startup founders don't really do is doing their own research. You should be reference checking your investors just like they're reference checking you. Understand how you fit in their portfolio, understand their value add and what they bring to the table beyond capital. I think that's best illustrated as, choosing the right partners is almost akin to The Bachelor, right? There's a common adage: investments and choosing a VC is like a marriage, and we don't take that lightly. Every investment we make, we're committed to for the long term. You should get to know your investors, their motivations, their values. Just like before a marriage, what do? You go and you meet your spouse's family. You should do the same for VCs. Go and speak to their portfolio companies. Go to speak to their colleagues. See what they have to say. See where they've been helpful. Understand their fund structure. Going back to the initial primer on what VC is, it's super important to understand a VC's fund structure and their strategy. Obviously, the delineation between generalist and specialist funds is important here as well. Generalist funds, their appetite for crypto, candidly, is correlated to crypto cycles. Specialist funds, crypto-specific funds, won't be phased by market cycles. They'll be in your corner, bull or bear. Obviously, very important to keep that in mind when choosing a partner. On to deal structuring and negotiations. I'll try to keep these brief, but the most helpful piece of advice is get a good lawyer. Get a lawyer who understands crypto, who's done crypto transactions before. Don't be cheap. Don't be afraid to spend on a quality legal team. It'll save you headaches and cost down the line. Probably the most important thing a lot of first-time founders and early stage companies get wrong: get a good lawyer. On valuation, a common question founders often ask is, how should I think about valuation? How do I set a valuation? What does that even look like? Founders should not be setting a price unless you're a tenured founder who has exited multiple companies, delivered value back to investors many times over. You should not be setting price. You don't want to back yourself into a corner. Obviously, the meme on the right is kind of a joke, but by setting an artificial price, you might lose investor interest, and you just candidly don't want to back yourself in a corner. You want to get offers, and to get offers, you want the market to decide on the price. One other common pitfall I see first-time founders make is you want to leave yourself room to grow. Valuations are a vanity metric. We all see these headlines of companies raising hundreds of millions of dollars at absurd valuations. That means nothing. That means nothing, candidly. You want room to grow. You need to grow into a high valuation, and ultimately raising at a high val will likely come back to bite you down the line as it sets a benchmark. And if you don't hit that benchmark, you're going to have a very tough time raising a subsequent round. One more thing to call out here is don't optimize for valuation, optimize for the partner you're working with. It's easy to get lost once again in inflated metrics and numbers. You want to find someone you want to work with for the long term, and hopefully that partner wants to work with you at a agreeable price. That is probably the key here. To walk through a typical example, most crypto VC deals are structured as equity plus a token warrant at the earliest stages. So what does that mean in practice? Let's assume a venture investor is investing $2 million at a 10 mil post-money valuation. The 10 mil post-money valuation is on the equity side. So that investor, the VC, would own 20% of the business with their $2 million investment. A common gearing for equity plus token rights, token warrant deals is a 2-to-1 ratio. What that means is, as a project decentralizes, right, they want to at least have 50% of the token supply going to the community. These are super rough numbers, but general best practice is at least 50%. So how does that manifest itself in practice? If you own 20% of a company's equity, you likely will own 10% of the token supply. Just wanted to quickly walk through this, as it might not be as apparent to folks in the space as how these deals are structured, but this is the most common structure we see. Common red flags from an investor's perspective. These should be self-explanatory as well, but one of the biggest red flags is just a general lack of honesty. As a founder, it's okay not to have all the answers. The worst thing you can do is pretend to have those answers and you are wrong. It's easy to kind of see through the noise as a venture investor. So yeah, just be transparent, be honest, be trustworthy. Once again, you want to be a steward of capital. A venture investor is entrusting you with the funds they're giving you, usually not a trivial amount of money. So you should be honest and trustworthy. Avoid buzzwords. We see pitches all the time. Restaking, this, AI, you name your buzzword, right? Try not to use buzzwords. Try to dumb things down as simply and cleanly as possible without using a splashy, fancy buzzword that's in vogue at the time. Arrogance is another big one. As I kind of mentioned, post pitch, if a VC passes, or even during the process, just don't be arrogant. Don't be an asshole. Number one rule. It's hard to see how you can lead a company if you're arrogant and stuck up, right? That is just clearly not what a good leader is and does. And yeah, it's one of the flags that will kill a deal, candidly. Another common one, this is more common in the crypto space, is just a short-term bias. If a founder is talking about token price, number go up, clearly they're not here for the right reasons and here for the long term. A true VC is patient, long-term capital, and you want to be building for the long term, optimizing for the long term, not focused on short-term gains. And the last one, this one is also self-explanatory, but you want to be devoted. You can't be part-time. To make your business successful, you have to be all in. So how should you set yourself up for future rounds? Send investor updates. The best teams communicate clearly, effectively, and frequently. As a VC, you want your companies updating you on what they've been doing, the blockers they might have run into, asking for feedback and help. And this isn't limited to just your current investor set. As you go through pitch conversations, create an email distribution list and send those folks, even if they pass on your round, investor updates. You want to be top of mind. That's the name of the game. As you go out and raise subsequent as you go out and raise subsequent rounds, the more top of mind you are for other funds in your network, the easier the process will be. And that kind of trickles down into relationship building. You want to continue building your network. It's easy to think, oh, I'm going to go out, fundraise. Now I'm heads down on product. I'm not going to speak to investors because I'm in build mode. Sure, that's great. And I think as a VC, you appreciate that. But also think you can't have that mentality. You need to be expanding your network. You need to be having conversations. Even if you're not fundraising, you should be speaking to VCs. Don't raise more than you should just because an investor wants to offer you, $5, 10, $20 million doesn't mean you should take that money. More problems is the classic adage, but money is not going to make your business successful. Full stop. Be mindful of market timing. This is a big one, especially in the crypto space as a whole. You want to go out and raise when the market is doing well. You don't want to be in position where you're stuck raising in a bear market. Conversations are candidly going to be harder. Your metrics might also be on the downswing because of the market environment. So just make sure you're timing up your raises with favorable market conditions. Easier said than done, but always be mindful of the macro environment you're looking to fundraise in. And the last point, execution. This is probably the most important thing. You will find it very easy to raise subsequent rounds if you've executed on what you said you were going to do. If maybe you've struggled, maybe it's a pivot. That's okay too, but you want to have demonstrable proof points of execution, because ultimately the best founders and the best teams are the ones that are heads down executing in the trenches day in and day out. I will wrap there. Would love to open it up to Q&A. Happy to answer questions on what we at Faction look for in teams, how we think about the space, how we think about early stage companies and financing rounds. Happy to answer any questions top of mind. Hopefully this was helpful. It's always helpful to unpack, what venture is. And once again, ultimately, I think it helps early stage founders choose the right capital partner, someone who's committed over the long term, and will obviously help the business grow and succeed as the years go by. So would love to open it up to the questions.
Amazing. Thank you, Will. I think that we've already got a couple questions, so I will read them out. We'll do those live. Okay, so the first question is, how do early stage projects find a lead investor when starting from zero?
Yeah, good question. This is what I would do as a founder, and this is what I give early stage teams advice on. So go out, as I kind of mentioned, there's great VC databases. I think Masari has one. Go out and look at past financing rounds over the last 3-6 months. Look at who the lead investors were for those rounds. If you're raising a seed round, go out and look at all the seed rounds raised over the past 6 months. Go through that investor list, and those are the lead investors you want to target. Anyone who's not the lead investor there, maybe it's a co-lead investor, but they're likely not going to be the lead. That's just their fund strategy, right? Might be writing smaller checks, having more portfolio companies. A spray and pray model is kind of what we call it in VC land. That's fine. Those are great follows. Usually follow-on checks are the more strategic parties, whether it's market makers, exchanges, think corporates like Coinbase. Folks like that are usually better suited for the follow slot than a lead slot. So go through the VC databases, look at who's done seed rounds, look at who's led those rounds, and build your list from there.
Okay, so next question is, I have a project that doesn't need a lot of startup capital. There are things I would like to hire out, like art generation, but it's not absolutely essential for the success of the project. A primary goal of investment capital would be to pay myself for my work, allowing me to stabilize my financial situation, allowing me more time to work on the project. And I'm willing to sell future earnings potential in order to obtain that. How do VC investors view projects in my situation, and how should I go about presenting this professionally and honestly to potential investors?
Yeah, that's a great question. This is a tricky one. The candid answer is you're probably not well suited for venture capital. If it's a part-time gig, you want to be able to devote more resources to it. Raising venture is probably not the right strategy for you. I would go out to your network, maybe it's friends and family, maybe you can get some sort of financing, whether it's from a bank or whatnot, to be able to spend more time on the project. But to raise venture, you need to be committed. It's not a side hustle, as I kind of mentioned. And ultimately you need to think those things through. If you can bootstrap, do it. Raising venture is not going to make your company successful. We'd like to think that as VCs at the end of the day, that we invest in a company and we're the ones that are making these projects successful, but ultimately that's not the case. So if you can bootstrap, go for it. In your situation specifically, it's hard to really give advice, but feel free to message me after. Happy to chat one-on-one, but there are other avenues you can and should explore.
And the next question is, in regards to the valuation for a pre-seed company, would you recommend a safe agreement?
Yeah, safe is the market standard. They're quick, they're easy. Every VC understands them. Most lawyers, you might bring on board will understand them as well. A market standard, safe plus token warrant is kind of how we like to see deals. So yes, definitely a safe.
Okay. Hi, Will. Thanks for the great advice today. I have a question about proof of traction when having VC conversations at the seed stage. It seems there is significant value in trying to demonstrate proof of traction slash user interest before VC conversations. There also seems to be an argument to be made to elevate the product quality through partnerships before onboarding any users. Do you have a point of view on this?
Good question. I mean, investing at the seed stage, at the end of the day, most seed stage investments are a bet on the team and the vision. Metrics are great. We like to invest behind early proof points of adoption, traction, whether that's a test net or yeah, maybe it's, you bootstrapped a project and have built something that users want, and there are proof points behind that. It's not the end of the day if you don't have traction. It will be harder to raise, especially if you're looking to raise, a meteor seed round or have raised a pre-seed round previously. So to the extent like you can go out and get early users, get early adopters of your project protocol, you should. The conversations will flow much more easily. VCs like that. VC is ultimately a game of risk, but the more de-risk you can make it for an investor, the easier those conversations will be. So yeah, I think I touched on the first point, and Jesse, remind me of the second one.
The second point was about elevating the product quality through partnerships before onboarding any users.
Yeah, maybe a hot take, but you can, and it's great to have partners lined up. Obviously, it's a core tenet of go to market. I can't speak specifically, obviously, like I don't have a ton of context on what you're building. But yeah, it's great to like establish partnerships with fellow builders in the space and be able to tap into their networks, their user bases, et cetera, et cetera. But yeah, I mean, setting up partnerships pre-launch, it's not going to make your project successful, and it will be the reason why a VC invests in you versus someone else.
Okay, this might be the last question, unless we get one more quickly. Oh, never mind, we already got one. So, in your opinion, are there certain types of products that VCs are more interested in than others in the Web3 space? Maybe you could talk about favoritism towards products.
Yeah, this is definitely a hot topic. Most of you have probably seen the classic meme of you know infra. Everyone only funds infra projects. We have so much infrastructure, but who's even going to use like the infrastructure if we have no apps built on top? Uh, Sadly, I do think it is the case. Like VCs do like infrastructure. Why is that the case? Like classic picks and shovels dilemma. When you have gold miners rushing in, what's the best business model? It's to sell shovels. Um, so what does that mean? Where do we look? We invest across the stack, as I kind of mentioned, L1 all the way up to the application layer. Is there a specific piece of that captures more value? Arguably, yes and no. I think for the ecosystem to grow as a whole, we need successful applications. Successful applications obviously bolster the adoption and usage of the infrastructure, which bolsters. It's a very nice flywheel. Obviously, goes back down, trickles to the L1. So I think, is there a right place to be building in the stack? No. Where you should be focused is where are you uniquely suited to build? How is your project solving a acute need in market no one else has solved before? And yeah, what's your differentiation? Ultimately, like that is what makes or breaks a successful business, in my opinion. But yeah, hopefully that's helpful.
And given the current US regulation, do you at Faction and other VCs still have a preference for incorporating as a Delaware C Corp, or is there more flexibility and any alternative preferences outside of the US?
Yeah, that's a great question. We are flexible. We are flexible. We don't have a strong opinion here. I would advise you to seek counsel depending on, how you see value capture, whether it's via equity via a token, seek counsel. I'm not a lawyer. Do your own research, but we invest globally. We invest across, Delaware C corps to your more esoteric structures. So like it is not an issue from a venture investor's perspective. It's more an issue like get counsel, understand the ramifications it has for you as a founder, and yeah, I'll leave it at that.
If the founders that you'd be investing in don't have a vesting schedule, would a VC walk away if this was not already in place?
No, they wouldn't walk away if it's not in place per se, but they will want a vesting schedule in place. And if you're not willing to put one in place, they will walk away. Or at least any VC who's worth their weight should and will walk away.
Okay, I think we'll give it 10 more seconds, but I think that's the last question. But I'll give you guys 10 seconds to write another one if you have one. Thank you, by the way. We got a lot of good questions today.
Yeah, really appreciate these guys. And once again, as I kind of mentioned before, feel free to reach out to me on Twitter, on Telegram. Happy to chat more through specific questions you have as they relate to like your project specifically. Happy to be a resource through your process as you think about going out pitching investors. I'm in your corner. We at Faction are huge ROE of ecosystem supporters and AO ecosystem fans. So to the extent we can be helpful, the classic VC beam, let me know. Let me know how I can be helpful.
Amazing. Okay, I think we'll end it there. Thank you, Will. Like I said, I think this presentation is going to be really useful for some of the first-time founders that are in this cohort, and we're going to have the recording up soon. And then for everybody participating in AO Ventures, we're going to have updates on Demo Day coming soon, so stay tuned for that. And as always, we're excited to see how your projects develop and supporting you in building out the permaweb. So I'll see you guys at Demo Day the next time. Thanks, Will. See
Awesome.
you guys.
Thank you. Thanks,
Bye.
guys.